This Week in Economics on WBRN Radio and the Bostonred Network. The date is the 16th of June, 2018, brought to you by Cranston Analytics. He's been our partner for roughly the last 17 years or more that we've been doing projections at this stage. Prior to that, we were Cranston Econometrics. Anyway, the name sort of changed, but that would go back over 20 years ago. So we're still around, still doing this. Some of the keynotes, the Federal Reserve, of course, met on June the 13th, and they raised their interest rate from 1.75 to 2%, 25 basis points. For those following along with them, these are some of the projections. We'll have Chairman Powell, after we are finished here, we'll look at the Fed and we'll look at the cause of an interesting study I just looked at. We'll get to it in a minute. The actual cause of the depression of 2008. But nonetheless, we'll look at some of these projections changed in real GDP March projections of 2.8. That is their projection 2019 2.4 and 2 in 220. The long run at 1.8. You see where this is going, that the GDP actually in the long term, that would be 2021, etc., they expect to go down. Now, the central tendency, 2.7 to 3 in 2018, 2.2 to 2.6 in 2019, and 1.8 to 2 in 2020. And the long run is basically the same thing, and that was the change in real GDP. Now, the March projection was 2.7, 2.4 in 2019, and 2 in 2020. The unemployment rate, a rate of redundancy, is 3.6, is their projection in 2018 to 3.5 in 2019, 3.5, the same. The long term at 4.5, this is the Fed. The March projection 2.8, that's where we stand now, 2.6 in 19 and 2.6 there. The CPE inflation rate at 2.1 this year, 2.1 next year, and 2.1 in 2020. The long run at about 2. Now the core PCE inflation at 2. This is core, and 2.1 and 2.1. Now, in a modern capitalist economy such as this, industrial economy, you can run at anywhere basically between 2.5, and 3. You can run a little above that, but then your inflation starts eating things up and causes some problems. And this is sort of a dual situation. As interest rates go up, it's good for savers, but interest rates on other things. We have a little summary here from a number of analysts, one from bank card rate or something.com. Many of these new outfits that have appeared, nonetheless, that with credit card borrowing, mortgage rates, that would all go up also. So once more, you have that particular situation appearing there, and that is one of the things the Fed looks at. From Chairman Powell, the general idea was you can always raise rates, and they probably will raise rates 1 or 2 more times this year. That would be what, at 0.25. So effectively, you could have anywhere from 2.25 to 2.50. But you can always lower rates. In other words, that is one of the macro economic tools that you have in your tool chest. if when you have rates at almost zero, you don't have any way of dealing with that. In central banks, primarily that is how they do it. As far as quantitative easing, or somewhat some people would call quote-unquote easy availability of capital, that is winding down, and the Fed is also selling off of some of its assets that it had acquired. And this will go on as they get back to a normalization. The missing part of this puzzle, and this is one of the things that causes havoc with the models. You have a very low unemployment rate historically, going back roughly 20 years. But at the same time, objective conditions are totally different. You have a totally different type of workforce. The last time the U.S. saw these types of rates, the baby boomers were in the mix. Now the baby boomers are going out of the mix, which creates some problems. And also at the same time, we have robotics we didn't have 20 years ago in the U.S. economy, the influence there. And you also have the so-called gig economy, the Ubers and those of the world that people are working quote-unquote flex time. But many times this is disguised for part-time work that should be a full-time work. So you have those things going on, and at the same time you have compensation wages that are pretty much flat overall and not keeping up with inflation, i.e. Rents and various other energy products, etc. In the U.S., if gasoline prices go up, the consumer has less discretionary capital available. Now, one of the, I guess you'd say, positive steps is the earning rates are up. The saving rates are up. The market, that is a different ball game. We'll talk about that later from Bloomberg. But that is a situation where prices go up, prices go down. They're somewhat influenced by geopolitical concerns, but not as much as at one time, because part of the problem here is so much political, quote-unquote, instability, but minor instability. For example, the recent Singapore summit, the market did not respond one way or the other in terms of any long-term sustainability in that particular sector. And the availability of a petroleum product is available, and the political concerns on Iran are not apparent in Venezuela. We don't hear very much about Nigeria and where they are in terms of pumping, but there's plenty of crude out there, and we'll look at those pricings also. So the Fed's dual mission is stability in the employment and also in the economy sector. And Chairman Powell will talk more about that particular situation. Let's just go. The macroeconomic conditions that led to the what they termed the financial crisis. This is by Michael Keeley. Sorry about that. Keeley. The crisis, the abstract research has suggested that a rapid pace of non-financial borrowing reliability proceed to financial crisis, placing the pace of debt growth at the center of framework for deployment of macroprudential policies. I consider the role of asset price and current account deficits as a leading indicator of the financial crisis. Run-ups in equity and housing prices and a widening of the current account deficit had substantially larger and more statistically significant effects than the debt growth on the probability of a financial crisis in a standard crisis predictive model. The analysis highlights the value of graphics of predicted crisis probabilities in an assessment of predictors. And let's look at the conclusion to his study here. Our analysis suggested that housing prices, equity prices, current account deficits had substantial leading information in econometric models to predict the occurrence of a financial crisis. In contrast, credit is relatively uninformative. This finding differs from the emerging conventional wisdom focused upon debt accumulation. These findings point to direction for future research and policy analysis. With regard to research, structure models emphasize the interaction among asset prices, external borrowing, current account deficits. Debt accumulation may inform interpretation of these empirical results. With regard to policy analysis, guidance associated with the discussion of countercyclical capital buffers from the Basel Committee have focused on the level of debt relative to income, in part because debt has been found to predict crisis. Similarly, research on the effects of monetary policy on financial stability have focused on the effects of monetary policy on debt. The results herein suggest a focus on asset prices and current account deficits may be useful. Now, this is a very, very important factor in terms of models that we have. And one of the big problems is regulatory situations as we normally have going forward here. The statsgeek.com blog, we won't go into that, but we'll append this particular study here. A lot of very, very important information if you want to go further there. We started reading this and just continued on. David Roma, if you remember, this was 2013, preventing the next catastrophe. Where do we stand? That was the IMF blog. We've had a lot of information there coming out of that particular situation. The rest of this is purely statistical, and you can peruse that at your leisure, as with most economists. Now, obviously, policy has entered in. This is a financial and economic discussion series, Division of Research, Statistical and Monetary Affairs at the Federal Reserve Board. What macroeconomic conditions led to the financial crisis is it? And this is Mr. Keeley here. Staff working papers in this particular area here. This is released on the 4th of May, and we already talked about the abstract here. We won't go further into that particular situation. Let's move on now to where are we going to move here? We'll do the IMF here. Broadly, this is the IMF, the macroeconomic outlook, the near-term outlook for the U.S. economy. This is from the IMF. Is one of strong growth and job creation. Unemployment is already near levels not seen since the 60s. And in our discussion, we talked about the 60s and what the 60s featured. A totally different feature today. The baby boomers were just getting started. In the 60s, you're relatively 20 years since the Great War. And the 50s, the return of soldiers from the Great War that had used the GI Bill, and of course you had housing booms and that sort of thing going on, and you had stimulus, of course, from the Great War that ran to 1945, a little beyond, and there was a recession in 48. But pretty much the 50s were times of boom, and into the 60s you had the Vietnam War. So back to this, growth is set to accelerate, aided by near-term fiscal stimulus, a welcome recovery of private investment, supportive financial conditions. Did not have financial stimulus in those days. We had what was called a pump priming. These positive outlooks, outturns have supported and been reinforced by favorable external environment with a broad base of pickup in a global activity. Next year, the U.S. economy is expected to mark the longest expansion in recorded history. The balance of evidence suggests the U.S. economy is beyond full employment. However, despite good near-term prospects, a number of vulnerabilities are building up for medium term, and it says below here, slow but steady rise in wages and price inflation is expected as labor and product markets tighten. After spending much of the past decade below the 2% core PCE, inflation is expected to rise modestly by mid-year. It's already done that so far. Wage growth has been broad in line with relatively weak labor productivity, leaving unit labor costs virtually unchanged over the past 2 years. Fiscal policy, with a strong cyclical position as a backup, the U.S. has cut taxes, raised both defense and non-defense discretionary spending. The results, demand stimulus is expected to raise output cumulatively by 1.5% by 2020, pushing the unemployment rate below, and this is what the Fed, 3.5. The tax change is expected to have modest positive supply side effects, largely by incentivizing an increase in capital stocks, and in doing so, raising the level of potential GOP by a cumulative 0.3% by 2020. Potential growth is expected to return to long-term at basically 3.75% by 2021. Now, this is something to look out for here. In other words, the out years, we're in 2018. In roughly 3 years, the projection is, and the economy will be saddled with quite a bit of debt, but there will be problems. The combined effects of the administration's tax and spending policies will cause the federal government deficit to exceed 4.5% of GDP by 2019. That is next year. This is nearly double what the deficit was 3 years ago. Now, this is very, very important. Reagan ran a similar situation, but not on this scale. Such a strongly procyclical fiscal policy is quite rare in the U.S. context and has not been seen since the Johnson administration. Now, in the 60s, different situation there. Such a procyclical fiscal policy will elevate the risks to U.S. and global economy. This fiscal path will provide a near-term boost to the U.S., and this is short-term, and to many of its trading partners. However, it also increases the range and size of future risks both for the U.S. and the global economy. High public debt, increased federal deficits will exacerbate an already unsustainable upward dynamics in public debt to GDP ratio, even with planned modest fiscal consolidation is scheduled to start in 2020. The federal debt will continue to climb, exceeding 90% of annual GDP by 2024, which is relatively short there. Great risk of inflation, of an inflation surprise. As discussed above, the tax reform is expected to have only modest effect on potential output. As such, the planned expansionary fiscal policy raises the risk of a faster than expected rise in inflation. And Chairman Powell sort of touches on this, but he really doesn't get to it. The Federal Reserve to move at a faster pace than it is currently priced in by the markets, potentially creating volatility and disruptions in the U.S. asset markets. The U.S. asset markets have been working basically in an artificial atmosphere for a very, very long time, depressing a term and other risks pariahs and sustaining levels of corporate and household debt. International spillover risks, the shift in U.S. policy. A mix also creates important adverse risk for non-U.S. corporations, households, etc. They are borrowed heavily in dollars and have significant rollover needs. The risk of future recessions, but these are current policy gradual consolidation starting in 2020, a turn when monetary tightening cycle is expected to be at its peak. Staff forecasts assume a gradual slowdown during the period. Now this is at 1.5% slowdown. You're going to have that and increased global imbalance. The external position in 2017 was modestly weaker than implied by medium-term fundamentals and desirable policies. The U.S. dollar is judged to be modestly overvalued, no doubt about that. U.S. is likely to translate into higher import growth and increase in a current account deficit to around 3.5% of GDP by 19. Now, I don't know, haven't read this whole thing, and I usually do, measures taken to raise primary fiscal surplus of general government to around 1.25% of GDP, 1.5% to the federal government. Debt ratio, very, very reforming Social Security, raising the income level for contribution indexing benefits to channel inflation, raising the retirement age, and instituting greater progress in a benefit structure, containing healthcare costs and inflation, technology solutions that increase the effectiveness and greater cost sharing with beneficiaries and changing mechanisms there. One of the problems have healthcare costs, the continuous move to managed care, which in itself mismanages the healthcare system, and at the same time adds a layer of cost. Part of the problem you have when you have managed care is that managed care, and we're talking about the private management care operations, they tend to minimize costs and maximize the profits. The problem there is, as one fellow said, I think it was Stephenson at AT&T, penny wise and pound short. So those are some problems there. Period. Increase federal revenue GDP ratio by putting in place a broad-based carbon tax, federal consumption tax, higher federal gasoline tax. California has done some of this, but politically would it be palatable? Sort of doubting that. In monetary policy, in light of planned fiscal stimulus, the Federal Reserve will need to raise policy rates at a faster pace. We talked a little bit about this. We'll append this report. Tax policy, there's a broad agreement on the objectives underpinning the Tax Cuts and Jobs Act. Specifically, as pointed out by the administration, the tax code has long needed an overhaul, and we disagree there. And U.S. Business tax compatibility provide relief to lower and middle-income individuals. And lower statutory rates and broader base increases equity by taxing households at a similar level of income in a uniform way to independent types of businesses. That is one of the things that are out. However, approval tax changes have a high budgetary cost. In addition, the temporary nature of many provisions creates significant tax policy uncertainty and instability in the tax system. As discussed above, the authorities should seek to prevent the tax changes from adding to a fiscal deficit by increasing revenue to GDP ratio. Part of the problem there is it's not, this whole tax regimen is a short-term tax regimen. The reduction in the statutory business rate to around the OECD level, and you'll hear Chairman Powell talk about this. We won't spend time on it. The personal income tax changes, the personal income tax may have positive aspects. They eliminate most itemized deductions and raise the standard deduction, eliminate personal exemptions, limit deductions for state and local tax. Not a good idea. Needlessly, the net effect of tax policy changes, which include reductions in the broader alternative minimum tax, a reduction in marginal rates for higher income households. Pass-throughs, allowing for a 20% deduction for pass-through income, creates an important mechanism for higher income individuals to reduce their tax obligation by recharacterizing personal incomes as a pass-through income. This is counter to authorized objectives of increasing equity, especially between taxpayers that can and cannot arrange these activities. Much more business friendly there. And trade policy, well, we'll talk about that. The tariffs increase that U.S. and its trading partners should work constructively. That is not happening. Financial oversight, we talked a little bit about that. Raising of total asset threshold at $250 billion. This is a banking bill. The Volcker rule, let's see, they touch on it a little bit here, but the Federal Reserve's Office of Control of the Currency has proposed modifying the enhanced supplemental levels, etc. And somewhere here they touched on the Volcker rule. We won't spend any time. There remains to be a need to strengthen oversight on non-banks. That has been a problem, the so-called shadow economy there, these various characters that sell everything from annuities on. That has become a very, very significant part. Little progress has been made in reforming the housing finance system and the government-sponsored enterprises. Fannie Mae is still out there, and we don't hear anything about them. Competition policy, the market power of corporations is being more pronounced across a range of industries with important macro effects. Margins between price and variable cost markups have been rising significantly since the 80s. Measure of industrial concentration. We look at that with some of these mergers here. Corporations' level debt suggests that these trends have been driven by an increase in rents that are occurring to a relatively small but growing number of superstar firms. Some have been created a series of mergers and acquisitions. This needs to be talked about. We don't hear very much about it. And what we do have here, and this is from BBC, the 25% tariff. Let's see if we can get. This is from Bloomberg. The next move after the tariffs hit China back in a trade war opener. This is from Bloomberg. Jeff Black here, writing on the 16th. China in kind's response to DJ Trump's announcement of $50 billion of tariffs on imports is a gift. Has left the global economy on a verge of a trade war. Not a good thing. Period. Detailed partial list. This is will start on June 6, aimed at curbing China's industrial advancement. That has been talked about for a number of years with conservative policymakers on the political side. However, though, when you try to do things artificially, as this will do, you have consequences, not unintended. They obviously understand this. Period. China's response, released in detail on today, now raises the prospect of the U.S. will impose more duties following a pledge from Trump on Friday. For now, weeks of shuttle diplomacy, useless time. Chinese massive trade surplus with the U.S. has produced nothing. Well, the Chinese are moving more to an internal economy and this will only push them to do it much faster than their 25 part of there where they've talked about bringing various sectors in. There is a little chance that this 3-week delay will allow for a last-ditch effort to avoid tariffs. This is from Michael Harrison, Asian Director at Eurasia Group in New York. The first round of tariffs on the $50 billion in goods is locked in. The rest of the escalation to a second round is considerable. Hours after the announcement, the finance minister in China listed 545 categories covering about $34 billion in exports to the U.S., subject to an additional 25. Now, these are agricultural products, soybeans, corn, wheat, along with beef and pork and poultry, plus automobiles, a second set of tariffs to begin at a later date covering other goods, including coal, crude oil, gasoline, and medical equipment. So they have a wide sector situation here. The U.S. imports about 506 billion of goods from China last year. Exported about 130 billion, leaving a deficit of 376 billion. That's according to government figures. Experts pin strategy of using tariffs to effectively curb manufacturing rise, while the USTR list does not target exports of China's goods that are the building blocks to becoming advanced industrial power. There's little evidence that tariffs will have any effect to prevent the nation moving into more advanced fields. And this is the whole situation that they are afraid of, but it is an eventuality, period. According to Andrew Pope, the mentality of Trump's team is a little strange. A more powerful way to stop China from moving up the supply chain is to stop selling them semiconductors. Well, yeah. But could they find semiconductors elsewhere? Yes, the question is yes. It has leverage over key, this is China, from the U.S. States that voted for DJ Trump. Now, this will have an effect on the election, levying additional taxes on American fruits, nuts, pork, particularly pork, some wines. The Chinese like sweeter wines, and Trump's tariff on steel and aluminium or aluminum affects product affects soybeans, and this is a rural sector: sorghum, beef, pork, poultry, fish, dairy products, nuts, and vegetables. Trade war hits Trump's target land, no doubt, in many rural communities, which has been a keystone situation for Trump. It will hit them and hit them hard. And some of those communities have had problems with commodities for a very, very long time. The new list includes more agricultural products, dairy, alfalfa, seafood, than the limited group published in April. This is an analysis from Shanghai JC Intelligence Cope. Gives China a big trade surplus in the U.S. It will be more difficult and complicated for China in the future to retaliate. It probably will, but what is not mentioned in this article is that China turning internally. China has roughly 1.2 billion people and has 100 and at least 20 nations as partners. And the quicker they reconfigure this trade situation, the better off China will be. We've been advocating this for many, many years. While the end game is a compromised trade deal, that means U.S. demands for stronger protection of intellectual properties. The road to the deal has become very ugly. No doubt, both China and the U.S. exporters will suffer considerable loss. Well, there are ways of looking at this. You suffer your loss on the front side and not on the back side, period. And this is a better way of to deal with things out there. We'll do one more of these, and we'll go and do the numbers here because we have quite a bit. Supply chain caught in a crossfire of a trade operation. They moved to target $50 billion. It's too early to tell which manufacturers will pass on higher costs to consumers and seek cheaper supplies outside of China. That is a move going on here. Makes transition from a low-cost assembly devices. This is like the iPhone. Some of those industries have moved to Milwaukee. Aloha, what the hell? Operation is now in Wisconsin. Boeing's the world's largest plane maker. Said it's assessing the effect of the supply chain. Phone makers, which count on China for about $12 billion in revenue last year, also said in an email statement it would be pushing for settlement, which will not happen. In relation to tariffs, the financial minister, of course, we already talked about that, had issued those particular situations. So we'll see where that all goes. And let's look at the stocks here, where the markets were. We'll start out in Asia. The Nikkei was down 0.34. The Hang Seng was also down 0.43. And if we go to Europe, we'll find the FTSE 100 index was down 1.70. The DAC in Germany was down 0.74 in the negative there. The Calculus in France was also down 0.48. And in Spain, the IBEX was down 1.07. And we move here to, let's see, where are we? The Dow was down 0.34. The S&P index was down 2.83. The Nasdaq Composite was down 14.66. The NEC Composite Index was down 34.31 in the U.S. Now on to commodities. Bloomberg Commodity Index was down 3.10. The Reuters Jeffers was down 2.83. The Reuters International was down 49.27. In the energy sector, we go to, we'll do Brent crude first. It was down $2.50 at 73.44. West Texas Intermediate was down $1.83 at $65.06. T-Boone Picken in his retirement is jumping for joy there. The gasoline index was down 6.78. Natural gas, it was up 6 cents. Home heating oil was down $7.17. Gold on the COMDEX, let's see, was down $29.80 at $1,278.50. The spot, it was down $23.38 at $1,278.94. Silver, all the precious metals were down 74 cents at $16.48 for any 1 bit carat, and copper was also down $7.25. And platinum on the spot was down $17.13 at 881. And we go to agriculture now. Corn was down $2. Wheat was down $3.75. Cocoa was actually up 86 cents. Cotton was down $3.35. Live cattle, we don't have pork bellies. I always complain. We'll have to find some pork bellies. It was up $2.90. So some of the things going on here with Bloomberg. I think we've hit everyone. Rolls-Royce, maker of airplane engines, etc., will cut 4,600 jobs. In the UK, be phased in. They are realigning their profit strategies. We don't have any recent information on Rolls-Royce, but we can look at some of the major defense contracts. This is in the UK. Rolls-Royce is kind of in the middle. Then you have Airbus at the bottom, and BAE Systems as a percentage of sales. They're over 30%, almost 35%. Rolls-Royce is at about 20, not quite 25%. Airbus is below 20%. These are labor costs in defense industry as percentage of sales. I see. So they're low cost considering some others there. Shares were up 4% shortly after midday. Rolls-Royce cut a deal with the trade unions to safeguard 7,000 frontline jobs, engineering jobs in the East Midlands for 5 years, and investment in UK aerospace facilities. So they had a loss of £4.6 billion in 2016, and due to setting corruption causes, in other words, there. Earnings were better than expected in 2017, with profits before taxes at $4.9 billion. So a little bit different situation there. And this is the BBC. I think we've gotten everything from the BBC that we need. That we need. In Australia, taxi giant is. A Chinese taxi giant is moving into Australia. Just looked at this as we were passing by here. Not sure who this is. The firm recently launched in Mexico. Just completed a month-long trial in Geelong, Victoria. Diese is the world's largest ride-hauling app, better known for driving Uber out of China. So this is somebody that's coming. This is very interesting. A giant Diese is launching in Melbourne, Australia on the 26th. Diese says its service will be offered in Melbourne with a core ride-sharing aim there. And Melbourne drivers are continuing to respond exceptionally well to the product we are offering. The app can be downloaded in Australia starting on Friday. Discounts will be capped at a minimum of 10 Australian dollars, and that is $7.45. Diese claims that to have 550 million users across its application and transportation services, including premier taxis, express cars, and food delivery. So we'll be monitoring this in the future. This will do it for our part. On to Chairman Powell. Chairman Powell is not a trained economist, but a business person. His little press conference doesn't last very long, but then we have the question and answer. I think we'll go ahead and include that about 50 minutes for those people that want to listen to somewhat, particularly what he had to say is basically what we talked about, and then some of the questions that are asked there, what the Fed will be doing. Incidentally, they will be holding monthly news conferences, a little bit different setup than under Chairman Yellen. But at the same time, is the information going to be out there? Well, they have some transparency going on. We can expect the data sets out there, but their look as far as the fight with inflation, he'll talk about the natural rate of employment. We'll talk about that in our next broadcast. We have spotlighted that before. Whereas the natural rate, well, people assume it's probably about 4.5%. As a natural rate, but again, below the natural rate there, and we'll see where they are. I think we had one other thing here. don't know. Now this is, we did have it here. Thinking of, well, oh, this is a big headline in the Washington Post. For the biggest group of American workers, wages aren't just flat, they are falling. And this is from the Real Earnings Index released by the Bureau of Labor Statistics. For all workers, the real average hourly earning for all workers increased 0.1% from April to May. Seasonally adjusted here, this results stems from a 0.3% increase in the average hourly being offset by a 0.2% increase in consumer price index for all urban people. The average weekly earnings increased at 0.1% over a month due to an increase in the average hourly earning combined with the unchanged average workforce. The real average hourly earning were unchanged, seasonally adjusted. That is from May of 2017 to May of 2018, combined for 0.3% increase in the average work week. Real weekly earnings increased at 0.3% over the period. That's a period of a year. Real average hourly earnings for production and non-supervisory workers at 0.1%. That's from April to June. In one of the better performing, well, not exactly, but anyway, estimate that 0.2% increase in the consumer price index from May 2017 2018. Real hourly earnings increased at the 0.1% there. The decrease in real average hourly earnings combined with a 0.6% increase in the average weekly resulted in a 0.5% increase in real average earnings. Now the next announcement will be on June live the 12th. So this is some of the things that are happening here. So in real earnings, the whole Washington Post, they are really flat. There's no doubt about that. We're a key group of American workers that fell flat from last year when accounting for inflation. And this, we just read this table to you. The measure of pay that takes inflation into account fell from $22.62, that was last year, to $22.59. Not a lot, but the rising of gas prices, very important there. So you had 0.1% increase there. And these increases is sort of falling wages promise to exacerbate levels of income inequality. There's no doubt about that. Will continue on, and as you can see, the political sphere here outpaced benefits of tax bill for lower income Americans. This is from the Washington Post last year. Say your car hold 12 gallons of petrol or gasoline, and you filled up your gas tank 9 times in the past week for reasons you spent an average of $61 this week. Then you had the day DJ Trump was inaugurated. So gas prices are going up. The Bureau of Labor Statistics looking at the household spent on an average, spent a bit over 3% of household income. This is from the Bureau of Labor Statistics on gas. In 2016, the average price was $2.14, and it now costs 78 cents more on the average. If the average were to hold at current price, the average American household would spend $700 more than it did in 2016. The percentage of income spent on gas would increase to 4.5%. Tax Policy Center calculates how much people with various income groups you would expect to see from the federal tax cut. The bottom 20% of earners will pay 3 or 4 times more in higher gas prices than in the tax cut, and that's very important there. So we'll see where we are in those terms. Let's see very quickly. We'll go to Gas Buddies here, and we'll see what the price is currently in on the East Coast. Okay. If we can. All right, $3.19 in Cambridge, Mass. And yeah, this is at Mobile Shell. $3.19 is the current. We'll very quickly go to California. Okay, well, depending on where you are, the lowest price there is we'll go down to Long Beach, I guess. $3.19 at Armco. So basically about the same thing if we look at Los Angeles here, and then we'll come back. And $3.30 at Armco, $3.39, I'm sorry, $3.43 at Unico, and $3.45 at Mobile, that's in Los Angeles. Now, if we go to we'll do Oakland. $3.37 at Armco there. At a quick stop, $3.49. So you can see where the gas prices are, roughly somewhere hovering around about $3.50 on the West Coast, a little bit cheaper on the East Coast. As you know, we see these prices. This is Gas Buddies. Oh. And where we start out in Boston. Here well. Could go down to New York while we're here. Yeah, let's see what we'll do. We have a little time here. Roughly $2.63. We have basically outside of Boston, but anyway, these are the 10 lowest prices. So average about $2.50, a little bit cheaper. We'll run down to New York, and we expect it to get a little bit, cost a little bit more. And let me see where we are here in New York. Here, wait a minute, we must have hit the wrong It was North Dakota. Oh, well. No, maybe not. Well, let's do New York City. I don't know where these other places are here. Relatively cheap prices there. Sunoco at $2.89. Pretty much it's what's running. So it's running basically about 60 cents cheaper than in California. Let's do Texas real quickly here. And well, they're really down here. $2.37 in Wichita Falls. So I don't know. Well, we'll look at Houston. $2.45. So it is relatively cheap. At a Walmart, $2.47. Citgo, $2. So it's effectively $1 cheaper in Texas than we'll see in California. Go back and review. I don't know why I'm getting a little bit happy with this, but looking at some of these, depending on where you are, and some of them a bit not very realistic. We go to San Francisco, $3.50, $3.59. I guess if we go down south, as they would call it, to Los Angeles. And this is all up in Northern California, so pretty much you're going to have some of the same in Los Angeles. You can go down to Orange County, but LA, yeah, roughly $3.45. This is some of the lowest prices, incidentally, but you can just guess at Armco and Mobile, $3.40. 45 cents is roughly $1 difference in the prices between the two. This will do it for us, for those in business next week. A productive one as we move through June, the first month officially of summer. And one of the things we didn't talk about in various parts of the U.S., cooling costs, home cooling and not heating. Electricity will go up because when you have 90-degree temperatures, 85, 90 to 100-degree temperatures, you'll have that also going up. For the consumer, obviously, keep your eyes on everything. And I noticed even for people that use the T, public transportation, etc., the cost has went up.
Good afternoon, and thanks very much for being here. I know that a number of you will want to talk about the details of our announcement today, and I'm happy to do that in a few minutes. But because monetary policy affects everyone, I want to start with a plain English summary of how the economy is doing, what my colleagues and I at the Federal Reserve are trying to do, and why. The main takeaway is that the economy is doing very well. Most people who want to find jobs are finding them, and unemployment and inflation are low. Interest rates have been low for some years while the economy has been recovering from the financial crisis. For the past few years, we've been gradually raising interest rates, and along the way we've tried to explain the reasoning behind our decisions. In particular, we think that gradually returning interest rates to a more normal level as the economy strengthens is the best way the Fed can help sustain an environment in which American households and businesses can thrive. Today, we've taken another step in that process by raising our target range for the federal funds rate by 1/4 percentage point. My colleagues and I meet 8 times a year and take a fresh look each time at what is happening in the economy and consider whether our policy needs adjusting. We don't put our interest rate decisions on hold or on autopilot because the economy can always evolve in unexpected ways. History has shown that moving interest rates either too quickly or too slowly can lead to bad economic outcomes. We think the outcomes are likely to be better overall if we are as clear as possible about what we're likely to do and why. To that end, we try to give a sense of our expectations for how the economy will evolve and how our policy stance may change. As chairman, I hope to foster a public conversation about what the Fed is doing to support a strong and resilient economy. And one practical step in doing so is to have a press conference like this after every one of our scheduled FOMC meetings. And we're going to do that beginning in January. That will give us more opportunities to explain our actions and to answer your questions. I want to point out that having twice as many press conferences does not signal anything about the timing or pace of future interest rate changes. This change is only about improving communications. My FOMC colleagues and I will also continue to issue our economic projections on the existing quarterly schedule. Now, let me go into more detail over developments in the economy, our economic projections, and our policy decision. Economic growth appears to have picked up in the current quarter, largely reflecting a bounce back in household spending. Business investment continues to grow strongly, and the overall outlook for growth remains favorable. Several factors support this assessment. Fiscal policy is boosting the economy. Ongoing job gains are raising incomes and confidence. Foreign economies continue to expand, and overall financial conditions remain accommodative. These observations are consistent with the projections that committee participants submitted for this meeting. The median projection for the growth of real GDP is 2.8% this year, 2.4% next year, and 2% in 2020. Compared with the projections made in March, this median growth path is little changed. In the labor market, job gains averaged 180,000 per month over the past 3 months, well above the pace needed in the longer run to provide jobs for new entrants into the workforce. The unemployment rate declined over the past 2 months and stood at 3.8% in May, its lowest level in nearly 2 decades. Meanwhile, the labor force participation rate has been roughly unchanged since late 2013. That is a positive sign, given that the aging of our population is putting downward pressure on the participation rate. And we expect the job market to remain strong. As you can see in our summary of economic projections, the median of committee participants' projections for the unemployment rate stands at 3.6% in the fourth quarter of this year and runs at 3.5% over the next 2 years, a percentage point below the median estimate of its longer-run normal rate. This median path is just a bit lower than that for March. After many years of running below our 2% longer-run objective, inflation has recently moved close to that level. Indeed, overall consumer prices, as measured by the price index for personal consumption expenditures, increased 2% over the 12 months ending in April. The core PCE index, which excludes prices of energy and food and tends to be a better indicator of future inflation, rose 1.8% over the same period. As we had expected, inflation moved up as the unusually low readings from last March dropped out of the calculation. The recent inflation data have been encouraging, but after many years of inflation below our objective, we do not want to declare victory. We want to ensure that inflation remains near our symmetric 2% longer-run goal on a sustained basis. As we note in our statement of longer-run goals and monetary policy strategy, the committee would be concerned if inflation were running persistently above or below our 2% objective. Of course, many factors affect inflation, some temporary and others more lasting, and at any given time, inflation may be above or below 2%. For example, the recent rise in oil prices will likely push inflation somewhat above 2% in coming months. But that transitory development should have little, if any, consequence for inflation over the next few years. The median of participants' projections for inflation runs at 2.1% through 2020. Relative to the March projections, the median inflation projection is a little higher this year and next. As I mentioned, today we took another step in gradually scaling back monetary policy accommodation by raising the target range for the federal funds rate by 0.25 percentage point, bringing it to 1.75% to 2%. We also made some changes to our policy statement, reflecting that policy normalization is proceeding broadly as we have expected. None of these changes signals a change in our policy views. For example, We removed the language stating that, quote, the federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. Since we introduced that language a few years ago, the economy has strengthened, and the committee has raised the federal funds rate from near zero to 1 3/4 to 2%. As we continue to note in our statement, we expect to make further gradual increases in that rate. As a result, if the economy evolves broadly as we anticipate, the federal funds rate will, over the next year or so, move well within the range of estimates of the normal long-run level. Therefore, we thought that now is an appropriate time to remove this forward guidance from our policy statement. We continue to believe that a gradual approach for increasing the federal funds rate will best promote a sustained expansion of economic activity, strong labor market conditions, and inflation near our symmetric 2% goal. We are aware that raising rates too slowly might raise the risk that monetary policy would need to tighten abruptly down the road in response to an unexpectedly sharp increase in inflation or financial excesses, jeopardizing the economic expansion. Conversely, if we raise interest rates too rapidly, the economy could weaken and inflation could continue to run persistently below our objective. The committee's gradual approach is reflected in participants' projections for the appropriate path for the federal funds rate. The median projection for the federal funds rate is 2.4% at the end of this year, 3.1% at the end of 2019, and 3.4% at the end of 2020. By 2020, the median federal funds rate is modestly above its estimated longer-run level. These projections are very similar to those made in March. Although the median federal funds rate edged up this year and next, most participants did not revise their projections. And I'll conclude by mentioning two additional matters. First, our program for reducing our balance sheet, which began in October, is proceeding smoothly. Barring a material and unexpected weakening in the outlook, this program will proceed on schedule, and our balance sheet will continue to shrink. As we have said, changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy. And finally, as discussed in the minutes of our May meeting, we're making a small technical adjustment in one of our tools for implementing monetary policy. To keep the federal funds rate in the target range, we rely on the rate of interest on excess reserves, or the IOER rate. Up until now, we have set the IOER rate at the top of the target range for the federal funds rate. In recent months, the federal funds rate has moved up toward the IOER rate as short-term interest rates have risen more generally. So to move the federal funds rate closer to the middle of the target range, we are now setting the IOER rate 5 basis points below the upper end of the target range. This minor technical adjustment has no bearing on the appropriate path for the federal funds rate or financial conditions more generally. Thanks for listening, and I'll be happy to take your questions.
Hi, Mr. Chairman. Jim Tankersley, New York Times. I have a question about inflation and a question about growth. On inflation, I'm curious if there's anything that's happened since March that has changed your assessment of the risk of inflation increases beyond what you forecast in the year to come. And on growth, you mentioned fiscal policy is adding to growth. And I'm curious if you could break that down a little bit further for us and say, what effect do you think the recent tax cuts are having on growth?
Sure. So since I wouldn't say anything has happened since March to really change the way I'm thinking about inflation or the way the committee's thinking about inflation. We've seen inflation move very gradually up toward our 2% objective, and part of that has been just idiosyncratic things dropping out from last March, which were holding inflation, measured inflation down. Part of it is just that continued tightening in the labor market and the economy more broadly is pushing inflation up. So we continue to think, and the committee continues to think, that we are just about at our 2% goal, but as I mentioned, not ready to declare victory until we sustain that over time, which we haven't done yet. You also asked about fiscal policy, and there's a range of views on the committee, and I think more broadly a range of views among economists generally. But I can say that the committee participants generally believe that the fiscal changes, that includes both the tax cuts, individual and corporate, and the spending changes, will provide meaningful support to demand, significant support to demand over the course of the next 3 years. And The other question is, what about the supply side? So it makes sense that if you lower corporate tax rates and allow faster expensing of investment, you will encourage greater investment. That should drive productivity. That should increase potential output. So that really ought to happen as well. I think the amounts and the timing of that coming in are also quite uncertain. There's also the possibility that there would be more labor supply from lower individual tax rates. Again, in amounts and timing that might be more uncertain. So that's how the committee generally is thinking about fiscal policy.
Hey,
Nick. Thanks. Nick Timmeros, The Wall Street Journal. So the Fed is about 4 interest rate increases using the projections released today away from what might be considered a neutral Fed funds rate. And I wanted to ask how you're thinking about what to do once you get to neutral. Under what conditions would you decide once you get there that it's okay to stop raising rates? And under what conditions would you want to keep going?
So for many, many years, we've been far from maximum employment and stable prices, and so the need for accommodative policy has been clear. As the economy has strengthened and as we've gradually raised interest rates, the question comes into view of how much longer will you need to be accommodative, and how will you know? How will you know where, at what point, policy will be neutral? Neutral meaning that interest rates are neither pushing the economy up nor trying to restrain it. So we know that we're getting closer to that neutral level. We don't have an exact sense of how that will be. So the committee is discussing very actively the questions that you raise. And really, it boils down to a question of what is appropriate policy. And, you ask, how will we know? So I think we'll be very carefully looking at incoming data on inflation, on financial readings, and on the labor market. We have to acknowledge that there are always wide uncertainty bands around the level of, for example, the natural rate of unemployment, but also what is the neutral rate of interest? What is that rate of interest that pushes neither up nor down? So I think we'll be guided by incoming data on the economy and try to keep our minds open as we move forward.
Okay. Howard and then Sam.
Hi, I'm sorry. Howard Schneider with Reuters. 2.1% above target for 2.5 years starts to feel like some of the alternate frameworks that have been discussed here, be it price level targeting or trying to set expectations higher so that you hit your 2. In deciding how symmetric is too symmetric, what sort of parameters are you using on that front?
Our target for our medium-term objective for inflation is 2% PCE inflation. We feel that target has served the economy well, and I'm strongly committed to it. The committee is strongly committed to it. The sort of barriers to making a material change to that would be very high because, again, we think it's fundamental and we think it's worked. You ask about price level targeting and that sort of thing. There are some ideas that sort of take cognizance of the fact that rates are lower. We're near the zero lower bound, and that could put downward pressure on inflation expectations if we're going to be down at the zero lower bound, and therefore sort of undermine the credibility of the 2% inflation objective. So the idea is to have kind of a makeup. If you're below target for a while, you have a time of being above target, and the idea is to enhance the credibility of that 2% target. This is an idea that's been written about for many years. It's not something that the committee has looked at seriously. I imagine we will be having discussions about it, but not something that we have on the calendar right now.
Well, thanks very much. Sam Fleming from the Financial Times. Over the weekend, we saw some significant tensions within the G7 in Canada. There is the potential, obviously, for further action against China right now, and retaliatory action from major U.S. trading partners. How big a risk do you currently see this as being to the United States economy? And what kind of feedback are you getting in terms of corporate investment intentions? Is this something that's beginning to feature more prominently in your own discussions with major U.S. companies? Thanks.
I ought to start by saying that, Congress has assigned us very important jobs and, maximum employment, stable prices. We have a role in financial stability that we share with other agencies. Congress has very specifically given authority over trade to the executive branch, so I wouldn't comment on any particular specific trade actions. I will say that we, of course, have broad contacts among business leaders around the country, and the Reserve Bank presidents in particular have that, and so they report in the Beige Book and then in person at the FOMC meeting, and they do come back and they say that concerns about changes in trade policy are rising, I think it's fair to say, and also that you're beginning to hear reports of companies holding off on making investments and hiring people. So right now, we don't see that in the numbers at all. The economy is very strong. The labor market is strong. Growth is strong. We really don't see it in the numbers. It's just not there. But so I would put it down as more of a risk.
Steve and then Donna.
Steve Leisman, CNBC. Mr. Chairman, you said there's a difference of opinion among economists, but looking at the longer run GDP growth rates for the members of the committee, there's not a whole lot of difference. It's 1.8 to 2 or 1.7 to 2.1, depending upon how you count it. Is that showing us that not a single member of the committee, including yourself, Mr. Chairman, agrees with economists over at the White House that they can achieve long-run sustained growth rates above or at 3% or higher? Do you believe in that?
First of all, that's a reasonable range, I think. It's not that we're all on the same number, but there are a range of views about potential growth, and there's so much uncertainty around this. The thing about fiscal policy is you don't have thousands of incidents you don't have big data in a way. You have very small data. You've got only a few instances here. So you have a lot of uncertainty around what the effects will be. They could be large. We hope they're large. But I think our approach is going to be to watch and see and hope that, in fact, we do get significant effects to potential growth out of the tax bill. And we're just going to have to see.
What have you forecasted, though?
I think we're looking at a reasonable range of estimates, and we're putting different participants are putting different estimates in, and we're going to be waiting and seeing.
Donna and then Marty.
Donna Borak with CNN. You said earlier that it's still a little too early to declare victory on inflation. I wanted to circle back on a question that was asked at the initial press conference about what does the Fed say in regards to the inflation target as symmetric? Like, has the committee given any further thought in terms of how comfortable it would be rising above, whether it goes higher than 2.1, if it reaches 2.2, 2.3, and for how long? And now that you're planning to hold these regular press conferences starting next year, how do you plan to explain that to the American people, that inflation is not overrunning?
What we've said in our statement of longer-run principles and monetary policy strategy is that the committee would be concerned if inflation were to run persistently above or below 2%, persistently above or below 2%. And that's what we mean by symmetric. We're looking at it equally on either side, and it's a matter of persistent overruns. We know that inflation is going to bounce around. For example, as I mentioned, later this summer, there's a good chance that headline inflation will move up above 2% because of oil prices. Things buffet inflation back and forth, but so we acknowledge that, we understand that, and if inflation were to persistently run above or below 2%, then we would be using our tools to try to move inflation back in the direction of the target. We do understand, though, that we don't have the ability to precisely hit that target, so we expect that inflation will be above or below, and we just hope that happens on a symmetric basis.
Marty and then Heather.
Marty Krutzinger, Associated Press. At this meeting, you hiked the funds rate. You changed the dot plot to move from 3 to 4 for this year, and you took out a sentence that you'd been using for years about how long rates might stay low. But you say that none of this signals a change in policy views. But shouldn't we see from this combination of things that the Fed is moving to tighter policy?
I think what you should see is that the economy is continuing to make progress. The economy has strengthened so much since I joined the Fed, in 2012, and even over the last couple of years. The economy's in a very different place. Unemployment was 10% at the height of the crisis. It's 3.8% now and moving lower. So really the decision you see today is another sign that the U.S. economy is in great shape. Growth is strong, labor markets are strong, inflation is close to target, and that's what you're seeing. For many years, as I mentioned, we had interest rates held low to support economic activity, and it's been clear that as we've gotten closer to our statutory goals, we should normalize policy, and that's really what we've been consistently doing for some years now.
Hi, it's your pal Heather Long from the Washington Post. Can you give us an update on what the FOMC thinks about wages? Are we finally going to see that wage growth pick up this year? I know you're forecasting a little bit more inflation, but is that going to translate through to wage growth?
Wages have been gradually moving up. Earlier in the recovery, there are many different wage measures, of course, but just to generalize, wages were running roughly around 2%, and they've moved gradually up into between 2 to 3% as the labor market has become stronger and stronger. I think it's fair to say that some of us, and I certainly would have expected wages to react more to the very significant reduction in unemployment that we've had, as I mentioned, from 10% to 3.8%. Part of that can be explained by low productivity, which is something we've talked about at the committee and elsewhere. But nonetheless, I think we had anticipated, and many people have anticipated, that wages, that in a world where we're hearing lots and lots about labor shortages, everywhere we go now we hear about labor shortages, but where's the wage reaction? So it's a bit of a puzzle. I wouldn't say it's a mystery, but it's a bit of a puzzle, and frankly, I do think there's a lot to like about low unemployment. And one of the things is you will see pretty much people who want to get jobs, not everybody, but people who want to get jobs, many of them will be able to get jobs. You will see wages go up. You'll see people at the sort of the margins of the labor force having an opportunity to get back in work. They benefit from that. Society benefits from that. So there are a lot of things to really like, including higher wages, as you asked. Our role, though, is also to make sure that maximum employment happens in a context of price stability and financial stability, which is why we're gradually raising rates.
John, please.
Just to follow up on Don Lee from the LA Times, on both inflation and unemployment, the new projections for unemployment lower than before and inflation higher. And how much is the Fed willing to accept that's an overshoot for both of those before it affects policy?
You mentioned that unemployment moved down and inflation moved up by truly small amounts. If you look at the summary of economic projections, things are moving by just a tick or even a semi-tick between now and March. And you ask, I think we take a longer run view that we're aiming for 2% inflation around 2%. We know that it'll be above or below. We didn't overreact, I think, to inflation being under 2%. We won't overreact to it being over 2%. And I think we'll always be using our tools to move inflation in the direction of the target if it moves away from the target persistently, as I mentioned. In terms of unemployment, you have to acknowledge that no one really knows with certainty what the level of the natural rate of unemployment is, the rate that is sustainable over a long period of time. And we know that probably that rate has declined as the U.S. population has become more educated, as it has become older. Older and more educated people have lower unemployment rates. We don't know this with precision. So we have to be learning as we go. We've got to be looking at data and informed by what's coming in. And as I mentioned, I think at the last press conference, estimates by members of the committee have moved down by a full percentage point since maybe 2012, as we've learned, as unemployment has dropped and inflation hasn't really reacted. So I can't give you a precise number, but we will be very much informed by incoming data. And this uncertainty is why the fact that we live in that uncertainty is why we've been gradually raising rates. We're not waiting for inflation to show up. We're go ahead and moving gradually and trying to navigate between two risks, really. One would be moving too quickly. Inflation never gets back to target if we do that. And the other is moving too slowly, and then we have too much inflation or financial instability, and we have to raise quickly, and that can also have bad outcomes.
Chris, and then Edward.
Chris Condon, Bloomberg News. Mr. Chairman, I have a couple questions about the interest the Fed pays on excess reserves. And you mentioned, of course, that the IOER was raised by the committee 20 basis points. And that's a result, as you said, of the upward drift of the effective Fed funds rate in that target range. Do you think that that's going to resolve that issue, or might there be further action required by the committee in the future to continue lowering IOER relative to the midpoint of the range? And further, was there discussion among the committee today about what's causing that? Is it purely technical, perhaps related to bill issuance, or is it telling you something about the level of scarcity and truly excess bank reserves? Thank you.
Thanks. So I would say that, remember, the important thing is that we want the federal funds rate to trade in the target range. That's the whole idea. IOER is the principal tool by which we assure that will happen. And we've said in our basic documents that we will adjust the use of our tools as appropriate. We don't expect to have to do this often or again, but we're not sure about that. If we have to do it again, we'll do it again. Again, don't expect it to happen. You ask why, and yes, we're looking carefully at that, and the truth is we don't know with any precision. Really, no one does. You can't run experiments with one effect and not the other. I think there's a lot of probability on the idea of just high bill supply leads to higher repo costs, higher money market rates generally, and the arbitrage pulls up federal funds rate towards IOER. We don't know that that's the only effect, and we're just going to have to be watching and learning. And frankly, we don't have to know today. What we really need is to have the federal funds rate trade in the range, and that's what this minor technical adjustment accomplishes.
Edward Lawrence from Fox Business. So with the numbers that we're looking at, you talked about more people getting jobs, the wages are increasing. Are we seeing with the fiscal policy, a fundamental shift in the economy where we have lower natural unemployment, also possibly a lower rate of natural unemployment and lower inflation?
Your first question really is, do we think the natural rate of unemployment is lower? So I think we do believe it has moved down significantly over a long period of time. We don't think that the natural rate of unemployment, it's not one of those variables that moves around a lot. It tends to be driven by slow-moving variables like the education level of the population, like the functioning of the labor market and things like that. So, it may have moved down too, on a cyclical basis, lower as the economy gets hotter and hotter. There's some possibility of that. But, the thing is, if you look back, there have been a lot of studies done, and, real-time estimates of the natural rate of unemployment have uncertainty bands, which are quite wide. So we have to remember that and very much be guided by the incoming data. You ask about inflation. Inflation, we look at the 2% inflation objective as something that central banks, the Fed, really control, and we have to be strongly committed to achieving that, using our tools to do that. I think in recent years, the dominant force has been, disinflationary, has been pushing down on inflation.